Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello, and welcome to another edition of the Grain Feed, brought to you by EverAg. This is your weekly news feed for all things grain and all things feed. Each week, we bring you updates on the markets with unique perspectives from an amazing team of analysts with the intention of helping dairy and livestock producers manage their risk. I'm your host, Jim Matthews, reporting from Chicago on another humid day here in the Midwest, but overall, a very nice little Thursday morning here in the Windy City. Joining me today, as always, from Kansas, Director of Feed Procurement, Mr. Jake Kingsley, and from just outside of Oakdale, California, Vice President, Risk Management, and all things dairy, Miss Tiffany LaMendola. Team, how are we today?
Doing very well, Jim.
Awesome. Thank you.
Excellent. Tiffany, did I get that right? Just outside of Oakdale.
You did. Yes, I'm just up into the foothills, right outside the valley.
Nice. Excellent. And Corey helped us remember that LaMendola, in fact, means the almond.
It does.
In Italian?
Italian. Yes, which is very fitting. We grow a lot of almonds here in California.
You guys grow a lot of almonds. It was perhaps fate for you to settle just outside of Oakdale.
Really, and to meet my husband, who gave me that name.
Nice. Excellent. Very good. Jake, is there anything happening in Kansas that we need to report on before I can turn to the markets?
There's the NBC World Tournament or World Series. It's a little baseball around the clock.
A little baseball around the clock. Okay. You're always talking about how much stuff is going on in Kansas. I just wanted, there's a weekly update for the viewers we could hit them on.
I won't share. We don't need you here. We'll just keep it to ourselves.
Watch yourself, because I'm coming. I'm coming to Kansas pretty soon, so watch yourself. Let's turn to the markets here for a second. Paige, if you would kindly timestamp the broadcast. It is Thursday morning. It's about 10:20 Chicago time. Just a quick turn to the markets, because it's been another bearish move here in the grain and feed markets over the past several days here. We do have December corn officially trading below $4 per bushel. We gave it a little bit of a test run yesterday. We, in fact, actually settled just one quarter of a cent below $4 yesterday on the final trading day of July. Today, on the first trading day of August, it's a little bit more of the same. Corn is under some pressure. We're trading at about $3.97 on December corn. So again, this market is looking at corn and saying, we just don't need to be trading up near $4.25 like we were a week or so ago. But we'll get to that here in a bit. We'll look towards November beans all the way back down to $10.15. $10.15 for Novi beans. That's down about 8 or 9 cents on the session. And then December meal, not as stubborn little byproduct here this week. We're back down towards $315 per ton on December meal. And then just to take a look at little December oil, we're down a whole bunch. We're down like 2.5% today. Another little sell-off in diesel oil. We're going to keep our eyes on that little sucker. We're down to $41.20 on December oil. So we got to keep our eyes on the entire soy complex. But again, we'll get to that here in a little bit once we are chatting with Jake. But first, let's turn it back to dairy and Tiffany. What on earth has been going on in the dairy market here over the last couple of weeks? Because last week we had Cole Adams on from our grain and livestock expertise. We got to touch on that for a bit. So we need to give dairy some of that love again. What do we have, Tiffany?
Yeah, because you missed an exciting week last week. I think we had a couple really big reports that finally kind of shook, especially our class 3 market out of the summer slumber. I would say both reports, the June milk production report, as well as the cold storage report, which gives us a read on inventories for June, leaned supportive to bullish, our team called. And it was really kind of that shot in the arm we needed to get that class 3 market some life again. We've made some really nice recovery there, but those reports in particular, with milk production landing a little bit softer than expectations and American cheese inventories being drawn down a little bit more aggressively than expectations, both kind of confirmed what we had been hearing anecdotally. This still is a very much a supply driven market. And those reports indeed said, hey, yeah, we're a little bit short on supply. And so this week was exciting. I think it was all about digesting those reports. And we were off to the races here for a couple days. We have hit the skids here a bit the last two. We'll see how spot cheese trades here today, but we are back up to really nice levels. Class 3 has joined the ranks of Class 4 market now, all sort of hitting that $20 to $21 mark. And as you said, with grains coming down, finally, as we're watching the markets, things have been moving in the direction that our dairy producers have been needing and hoping for.
Yeah, because, I mean, given just feed pricing alone, the last few years have been a battle, right? If you are the dairy farmer, just feed by itself has not been all that fun, which is why you lean heavily on a Jake Kingsley, Director of Feed Procurement at Everag. But given the fact that milk, let's say for the most part, has been trending higher lately and feed has been trending lower, the conversations, Tiffany, have certainly shifted a little bit. We're not saying that, everything is, coming up roses necessarily, but you do have a margin, at least looking out into these futures pricing of where milk is trading versus feed. Would you say, Tiffany, that the folks you're speaking with have at least expressed some enthusiasm towards where prices have trended on each side of the dairy and potentially the opportunity to lock in that type of margin?
Yeah, I think what you pointed out is really important. This is sort of about looking forward, right? I mean, the dairy producer themselves have not received a bunch of really good milk checks yet. I mean, they might have one decent one under their belt. So if they're not looking forward, it still doesn't feel super great yet, but it's our job to help them look forward and think about, as you mentioned, what margins might be out there. And I do think the market is offering us an opportunity to do some good risk management. And so, even if you're bullish, right, talk to your advisor and think about making a plan and sort of be ready to execute that when and if we hit those levels that might work for you. I mean, I do think we're probably protecting some margin out there now. Certainly costs for some folks, right? Every operation's different. But I was just looking in the class 3 space for the fourth quarter. Even if you put just a milk price floor in place through available crop insurance programs, you're at a level that is only 6 times in the last 23 years have breached that level. And so, we may be in different times now. That's great. But, put in those floors and hope that it's another one of those years we beat. As I look out into Q1, even though those levels don't feel as good right now, still only 4 years have beat that floor level that's available right now. So certainly if we gain any ground, it's only going to feel better. And then on the class 4 side, those levels have just been pretty phenomenal for quite some time here. So there are some good things to do, even if you're feeling bullish and optimistic. Maybe, still give it some thought would be my hope.
Yeah, I think, Tiffany, it's okay to have bullish sentiments and still manage risk, right? I think that is the purpose of being able to utilize risk management, utilize either insurance and or the exchange, is that you can still be bullish milk pricing, but also give yourself that floor in case this suddenly turns around on us. And I think, Jake, just even transition to your side, that's what we're trying to emphasize with folks for buying feed. It's okay for us to be bearish, but still want to step in and provide yourself some ceilings on the physical feed pricing via hedges. But also, even Jake, you've been talking to folks about, look at this futures market. We haven't seen these prices in 4 years. It's also okay to step in and start layering in with some physical pricing and physical purchases at these levels. So has anything shifted in your mindset, Jake, over the last week or two? Because I know alarm bells are going off for a couple of folks. We finally have that 3 handle on December corn. But for the most part, I think even just 7 or 8 cents higher from where we're trading at the moment, we're pretty active about getting folks to step in and either price and or hedge. Has the last week or two impacted your outlook on the market?
I think that little run up that we saw over the course of last week just kind of showed us how important it is to step in and start doing something here, right? I mean, we are, like you said, we're at the lowest levels we've seen in several years now. We had been talking with a lot of folks. The Midwest has corn and soybean meal basis values at very attractive levels. They're historically average, in my opinion. And so we had folks stepping in and buying sizable chunks of next year's feed without much hesitation in that area, just because the cash price is right where you would really like for it to be. We think futures could still work lower, but there's probably limited room for that to happen. So go ahead and step in and get some stuff done. The folks at the other end of the rail lines, we'd been a little bit more patient, trying to be more creative, utilizing options to hedge a portion of it and do futures only if you could get something like that done, and just try to remain patient on the basis front of your price there, because it seems like in the western part of the US, corn basis could arguably decline 20, 30, 40 cents a bushel before this is all said and done, which equates to $10 or $15 a ton. And then soybean meal basis feels like it could come down at least $15 a ton as well. So we wanted to be a little bit patient there and leave that opportunity available to us. But at the same time, if you haven't done anything, you got to step in and get something done, a quarter of next year or a good chunk of the October through March window, something to capture this break in futures while we're down here. There's a lot of opportunity to get good feed prices captured. There is still probably some downside, but it's somewhat limited. And like we saw, one headline can rally this thing a fair little bit in a couple of days. And then if you start to stack a few headlines, maybe we lose some yield or a few acres on this next WASD report, which will be out in just about 2 weeks, or they find something interesting with these crop tours that'll start running around the country in a couple of weeks, or we get into any kind of planting and production issues as South America gets into their next crop cycle in, say, November or December, you can start to take the bottom and move it a little bit higher with each one of those headlines. So definitely taking advantage while we're here. One of the interesting ones that we've been hearing here lately is folks still trying to push new crop cottonseed out there, and the prices are as good as or better than we've seen in a few years there as well. But crop conditions on that look average or better across most of the cotton growing regions here too. So we think cottonseed prices could still come down in a lot of parts of the country to the tune of $20, $30, $40 a ton there. So again, like you and Tiffany both said here, there is a theoretical margin between feed and dairy prices. So if you want to step in and get something started, that's very fair. But we do think there's still some downside opportunity to work on that one.
Yeah, and I think, Jake, we have to also keep in mind that, the futures price is a benchmark, right? And that's just part of your overall flat price, your overall cash price as the dairy farmer buying this feed, right? So it's not just a benchmark for us, though, either. It's a global benchmark. What's traded futures-wise in Chicago is a global benchmark. And I think we've seen some of these flash sales come in from the USDA that have signified that we have been committing fresh export sales over the last week or so. It's been primarily in the soy complex for the most part, but we have seen a corn sale or two as well, right? And that's all for new crop. There's been a couple unknown destination sales out there, which some people can or may assume that could be China. We don't know until it's ultimately potentially leaving port here. But it's important to note that it's not just our end users in the US looking at that benchmark and saying, 4-year lows, let's go. It's the international market is doing the same, right? So like our big, let's say, clients, if you will, from an import-export perspective. Yes, China's obviously the big one that folks are looking for, but, Mexico, who buys an enormous amount of U.S. corn, is thrilled to see this breakdown towards $4, right? So, I mean, it's not just us here on our side of the industry looking at this and saying, now is a great time to step in. The globe is very much doing the same, and we have to keep that in mind. And Jake, you noted that rally that we had last week. We can go from $4 to $4.25 like that. I mean, we did it in 3 days last week. So that's not to cause, alarm or to even suggest again that we are necessarily bullish. but it does provide that fresh reminder, manage risk, because those managed money guys, those funds have a massive, massive net short position. And the minute they start to get tempted to rebalance or start to feel maybe hesitant on how large that position is or how exposed they might be on a huge net short in corn, they look at a high pressure ridge potentially moving from the Rockies over the plains. That they're trying to gauge the U.S. political landscape and what potential trade wars might ensue depending on who takes the White House come January, right? Given the November election. So there's a lot happening there that can potentially shift this market quickly. So again, like we started with Tiffany there too, it's okay to have sentiments in one direction or the other. Just manage risk around it, protect yourself, especially while we're seeing some of the operating margins we have at the moment between milk and feed. So I think that's a ton of insight for today. Excellent work, Tiffany. Thank you very much for coming back. It is great to have you on the show.
I'm glad you finally had me back. Thank you.
Excellent. And Jake, of course, we value your insights and all of your inside scoop on what's happening in Kansas and all the excitement there. We love hearing from you. So please keep up the good work. We'd also like to thank the Everag Insights crew. Corey is sending me videos, what to watch from a music standpoint. She keeps the 90s and early 2000s fresh for us here on the grain feed. So a huge shout out to Corey for doing that. A big thanks to Paige and Lexi for their production magic. And thank you to the viewers for watching the grain feed. Contact information is on the screen. We greatly appreciate your feedback. That's all for today. We'll see you next time on the grain feed.